Hello, Team 201. We're busy with our video series on the conceptual framework, and we're up to the point where we're going to look at the qualitative characteristics. Briefly recapping where we've been so far in this video series is we've been thinking about accounting for an economic event. And before we commit pen to paper and we actually start doing the accounting for that economic event, there's a few processes you need to go through to start with. And one of the first ones you need to do is you need to consider who your users are. And we've seen that with the IFRS, when we're doing accounting in terms of IFRS, our users we are assuming is investors, lenders, and other creditors. And we hope to provide information that is useful to them. And if there's other parties that are interested, hopefully what we give those parties will help the other people as well. So it's about giving useful information on an economic event to this targeted user group. Then the other thing that we considered was that whenever we do something now in accounting and in IFRS, we're considering that this business is going to keep trading for the foreseeable future. So we're relying on the going concern assumption in that regard. Now, every time I do something on this blank piece of paper to record this economic event, I need to consider those underlying qualitative characteristics. It's these characteristics that will help you make information be useful. Because what is useful information? How do you define what is going to be useful to these people? And this is what the IFRS has now said, is when we want useful information, that information needs to be relevant to those users, and you need to faithfully represent what that information is to those users. So relevance is it relevant to their decision? I think the plain English meaning of relevance is, it's fairly obvious what that would mean to you is, does it have the ability to change your decision? Then faithful representation, basically, are you calling a spade a spade? Are you really showing what that economic event is in substance to the user? Are they seeing that in the way you're communicating it? You should really try and what you're communicating in financial reporting, you should convey what reality is. And this is an interesting part of accounting. Remember, your job is to communicate what reality is, not to create reality. So I'll leave that thought with you, and we'll perhaps come back to it in some discussion classes later on during the year. But we're trying to report reality as faithfully as what we possibly can. Now, the world is an uncertain place. It's not a black and white place. There's many shades of gray in the world that we're working in. So you won't always have a perfect measurement. You might have some uncertainty in how you measure an amount. So that's what's making you now move away from being a bookkeeper to being a professional accountant, and that you're going to have to apply judgment to decide, where do I trade off between trying to spend more money getting the answers more accurate, or at what point is it accurate enough? And where's that balance of giving useful information? So those are your two main characteristics in accounting that you need to look at every time when you're trying to make what you're communicating useful. And once you've met those two, you can further enhance it by saying, is this comparable? So your starting point is not necessarily comparability. We're hoping that by giving relevant information and faithfully representing it, in and of itself, that would achieve a comparability. But you do need to just sit back and think, is this comparable to what another company is doing? So you may need to research, what are your competitors doing? What are similar industries doing in their reporting of these unique events, for example? Are we doing it in a similar way? Pick up the phone and phone your accountant. The collegiality is so important between accountants, that we're working together, that we are talking to each other and helping each other out. Then in terms of verifiability, so when I'm communicating this information, can people independently verify that? Be it my auditor, be it the user himself. Is there any way that he can go and compare that to some other market information or whatever the case may be? Timeliness is an interesting one for students, because students tend to think of timeliness as, I need to meet the deadline for my assignment. That's not the case with financial reporting. What you're trying to do here with timeliness is you are trying to be timely in delivering useful information to users. In other words, you want to give information to those users when they need it to make their decision. That's what timeliness is about here. It's not about meeting the deadline of the Company Act. You have to submit your financials within 6 months or whatever the case may be. That is a different deadline for sure. But what we're thinking about in financial reporting is we're trying to give people useful information at the time when they need that useful information. And then lastly is understandability. And be careful with understandability. We're not going to assume that somebody with no accounting knowledge looks at us and must just understand what we're talking about. You're allowed to assume a fair amount of knowledge on the part of the user of finance and economics and accounting, perhaps not at the level you are, but you also then can assume that that person will go and do the effort to find out what you're talking about, why you're talking about it in that way. So just because there's a very complex economic event and the accounting as a result perhaps is complex as well, you don't leave that out of your financial statements and say it's not relevant, you can't faithfully represent it just because it's complex. We still need to faithfully represent that complex event. By all means, consider if it's the way you're communicating is useful, if you can break down that complexity a little bit, but you don't not show something just because it's complex. And then the last thing to do with these qualitative characteristics, and we've touched on it already, there's this cost versus benefit. At some point, it takes too much time, costs too many resources perhaps to fine-tune a measurement when close enough is good enough. You're not going to materially change a user's decision just because you spend another 100 hours trying to figure out how to measure this item more accurately. So it's all on that, giving useful information that can influence the user's decision. So if you do something that could change the decision, that's worthwhile spending more time on. Now, some things that I just need to clear up. This is a question that I pulled off an actual textbook. We won't mention sources or anything in this case, but I want to use it just to highlight some misperceptions that I need you to help me to help the world to understand. They don't really understand these things perhaps, and just clear it up for them. So the first words there is the prudence concept. And I want you to sit back and think, what does prudence mean to you? You've done it at school accounting perhaps, you've perhaps done it at first year, but what does prudence mean to you? I'm pausing that you take a moment just to think what it means to you, okay? Then let's look at the answers in this multiple choice question. The organization should match expenses and revenues. Well, that's not prudence, we do know that. And an interesting side comment on that. Matching is not something in accounting that we necessarily strive for. We'll discuss it with the recognition criteria later on, but we don't recognize an expense because the income's in this period or vice versa. You recognize something when you meet the recognition criteria for that. And if that happens to meet the recognition criteria in the same period for the expense and the income, that's great. Then you get matching as a result. But matching isn't the reason we do something. So that's the first misperception. Please go and clear up perhaps with your school teachers and things. We don't do accounting because of matching. We might achieve matching, but we first say, does this expense meet the recognition criteria? Yes, okay. We recognize it. Does this income meet the recognition criteria? Yes, okay, we recognize it. Oh, look at that, it's in the same period. That's nice, but that's not the reason we did it. Second option, the organization should be accounted for as if it will continue trading into the future. We've discussed that in a previous video. That's your going concern underlying assumption. The organization should be conservative when estimating revenue. Now we're sounding closer to the truth. Let's check the last one. Only substantial items enough to influence decisions of users should be recognized. And that comes down to the whole concept of materiality. And materiality are things that are capable of influencing the user's decision. Again, we'll come back to that later on in this video series and in the course. So the third option was the closest. And that's the problem we have with prudence. You know the answer that you gave initially when I asked you at the beginning of this discussion. And if you think that prudence means conservatism, you've been influenced, unfortunately, not entirely correctly. Prudence isn't about being overly negative. And that's the way it's often communicated. There's this perception of accountants being worst case scenario people. No, that's not what you're trying to achieve. What prudence is trying to do is to make sure you don't over or understate something. It's all about faithful representation. So you don't want to be deliberately conservative in accounting. What we want to be in accounting is faithfully representing economic events, not showing the worst possible case scenario, because that may be a 10% chance of happening. What is the most likely case or scenario? What is the most likely accurate measurement? That's what we're trying for in accounting, faithful representation. So our blank page, we still haven't started the economic event yet, but there's some important considerations that you have to go through pretty much with every economic event in accounting, almost every journal entry. You're asking yourself, who am I reporting this to? That's what is my target group, my investors, lenders, and other creditors. What would they find useful about this economic event? What will influence their decisions that they are making based on what I'm telling them? And then, is the going concern applicable? Is this business going for the foreseeable future? That'll influence my measurement basis. And now you know as well, everything I'm going to do on this piece of paper to account for whatever the economic event is, to make it useful, I need to think about those qualitative characteristics. Is what I'm going to report, the way I'm choosing to report it, going to give me relevant information that are faithfully represented? And I can perhaps then enhance those with enhancing characteristics like timeliness and verifiability, etc.